Diageo shares have climbed 10% over 2 months from their lowest point in a decade, touching roughly 1500p as this is written. The proximate cause is Sir Dave Lewis's restructuring, the same overhaul that just triggered a formal government notification of around 150 potential Irish job losses. That is the first tension. The market is rewarding a move that signals the underlying business is not recovering on its own steam. The bottleneck in this story is not the cost structure. It is whether the demand for Diageo's premium brands is cyclically depressed or structurally impaired, and those two scenarios produce radically different endpoints for the share price. Lewis arrived in January to lead a company whose shares had already fallen by a third before he walked through the door. Sales for the 3 months to September were flat. The U.S., Diageo's largest market, was described by Lewis himself as the biggest challenge. Barclays, with a 2,320p target reiterated this week, argues the market is too pessimistic and that Lewis's early discipline signals the same earning recovery arc he delivered at Tesco over 5 years. Terry Smith, one of the UK's most scrutinized fund managers, sold his entire Diageo stake and cited structural reasons, not macro timing, for leaving. The two most prominent institutional positions on this name, taken in the same month, point in opposite directions. That is not an analytical tie. It is a signal that the key variable is not yet observable in the numbers.
Barclays' 2,320p target sits 55% above where the stock trades today. The implicit assumption in that target is that volume recovers once Lewis has cleaned up the cost base and unwound the balance sheet. Morgan Stanley has quantified the structural counterargument. GLP-1 weight loss drug adoption could reduce alcohol consumption by up to 75% among patients on those therapies. That is not a fringe view. It is a named analyst firm placing a number on a demand variable that Barclays' bull case does not address in any public statement in this week's pool. The hidden assumption Barclays requires for its conclusion is that Diageo's core premium spirits brands, Johnnie Walker, Don Julio, Guinness, Smirnoff, are consumed by people whose drinking behavior is insensitive to GLP-1 adoption. There is no evidence in Diageo's own reporting to confirm or deny this. Net sales volumes were up only 0.4% in the most recent quarter. Progress, but barely enough to be called a recovery signal. Meanwhile, Diageo's operating profit guidance was cut to low to mid-single-digit growth for the year to June 2026, down from mid-single digits. The U.S. consumer environment, described as weaker than planned, adds a cyclical drag on top of whatever structural element GLP-1 represents. Terry Smith's exit reflected his view that the target market overlap between GLP-1 patients and premium spirits buyers is material, not marginal. Barclays' thesis works if the overlap is small. It fails if Morgan Stanley's 75% consumption reduction among GLP-1 users maps onto a demographic that Diageo's brands depend on. Neither firm has the data to resolve this yet, which is precisely why the stock is paralyzed between two defensible positions. The reversal card sitting in the middle of this debate, Diageo's real competitive moat is its distribution network across 180 countries, not any single brand, a structural advantage that survives demand mix shifts better than a brand concentration argument implies.
Lewis's record at Tesco was built on 4 moves: strip management layers, divest underperforming assets, cut the dividend to free cash flow, and refocus on the core value proposition. At Diageo, the first 3 are already in motion. The £2.3 billion sale of East African breweries to Asahi is progressing, with the Kenyan court in April dismissing a legal challenge that had stalled the transaction. Dividend was halved at the interim stage, a move that reduced the annual dividend cost from roughly $1.7 billion and redirected cash toward debt reduction. Net debt at the interims was $21.7 billion, still elevated, but moving in the right direction, with divestment proceeds incoming. Separately, cost reduction targets of up to $625 million over 3 years are publicly committed. The fourth Tesco lever, refocusing on the core value proposition, is where the Diageo analogy strains. At Tesco, the core value proposition was price and availability. Lewis reduced prices relative to discounters, and demand responded because the product category, grocery, was inelastic. At Diageo, the core proposition is premiumization, consumers paying more for branded spirits in a market where younger cohorts are drinking less, and a subset is medically reducing intake via GLP-1. The refocus Lewis named is price cuts on tequila brands like Casamigos, which is the opposite of premiumization. It signals that the premium positioning in at least one segment was not durable at full price. That is not a failure of Lewis's execution. It is a signal that the Tesco template has a structural limit at Diageo's demand layer. What capital flow data exists points in one direction. The post-January institutional re-engagement with Diageo stock appears to be buying the cost discipline narrative, not the volume recovery, because volume recovery evidence is not yet in the numbers to buy.
Diageo's Capital Markets Day is scheduled for 6 August 2026. That event is the verification anchor. Lewis will set cost targets for the executive committee, provide an updated North America competitive plan, and give the first public quantification of the divestment to debt reduction timeline. The question it must answer for the Barclays thesis to hold is not, is Lewis cutting costs? That is visible. The question is whether the cost cuts are buying time for volume recovery or papering over a demand structure that is permanently narrowing. For a holder, the hold decision rests on whether 6 August delivers a North America volume stabilization signal alongside the cost roadmap. Without that, the cost story is a balance sheet fix, not a share price re-rating catalyst. For a non-holder considering entry at around 1500p, the 2320p target is 55% upside if the turnaround follows the Tesco arc. The risk is not that Lewis fails to cut costs, it is that by the time the cost cuts land, the addressable premium market is structurally smaller, and the stock re-rates back down on a lower long-run earnings trajectory. The genuine counter-evidence the pool provides against the bull thesis is this. UK pub demand for Guinness was rationed last Christmas as supply was constrained, the most demand-healthy signal in recent quarters. Yet the share price still sat at 10-year lows when Lewis took over. That suggests even when demand signals are positive, valuation has further to travel than one strong seasonal reading implies. The invalidation scenario for the bull case. If the August CMD fails to name a specific North America volume recovery target, and if GLP-1 prescriptions continue to scale through 2026, the cost-cutting narrative exhausts itself without a volume catalyst, and the market reprices to a lower structural earnings base. Holders watch the August CMD for a North America volume stabilization number. Non-holders watch whether the GLP-1 demand data published over the next 6 weeks changes the denominator of Barclays' addressable market assumption. That is the variable the 2320p target is most sensitive to, and it resolves before the CMD. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.